Okay, folks, welcome. All the jobless people, all the night owl, or all the night shift people tuning in from your workplace. I don't know lah, okay? I don't know which one you are, or you are retired, just tuning in because cannot sleep. Okay, so FOMC today, rate decision. Quite interesting lah. For this round, right? We got a few stuff ongoing. Firstly, the NFP data, that came out last Friday was very considered very good NFP data lah. Okay, quite strong. So because of that, the yield actually went up quite substantially. You can actually, let's take a look at the yield. Okay, the 10-year yield actually sort of like rebounded very sharply, and then for the past 2 days it just dived lah. Okay, so today it went down quite significantly, mainly because of the CPI lah. The CPI numbers, the inflation was actually below expectation, which is good for a rate cut. But the thing is that I don't think Federal Reserve is going to take in today's CPI number as part of their decision making because it's too last minute already lah. Okay, they are doing the rate hike at 2 a.m. and then the CPI data came out like a few hours before the rate hike decision. So I don't think they're gonna take into account. But nonetheless, right? I'm sure they will. Jerome Powell will definitely comment something. Somebody will confirm ask about it, and then he will comment, and then the market will definitely price in one lah. Okay, so this kind of thing you don't have to scared about the market not following or lagging behind. The market is like always way ahead of the crowd lah. Okay, way ahead of the traders lah. So on top of which, right, we also have the ISM data. The ISM service actually rebounded quite substantially also. So let's just take a look lah. Oops, sorry. Where's my ISM data? So for the ISM, right, if you look at the service actually rebound very sharply. Okay, you can see it was below 50, then suddenly it rebounded quite significantly. And in fact, if you look at the business activity, it rebounded by 10 points, which is quite significant. Okay, which is quite significant if you look at the business activity. So this also, of course, means that the economy is still strong. So it is also another point for not cutting rates lah. But then again, right? Wow, how come got so many people? 10 people here. So many people cannot sleep. Normally this session usually like 4-5 people. Only now got double the amount. But anyway, there are a few things that we need to keep in mind also is that within the past 2 weeks, right, we have the European Central Bank, the ECB, and then after that we have the Bank of Canada actually cutting rates. So these are the two I would say the major economy that are starting to cut rate already lah. Okay, but in fact, right, before these two, majority of the Latin America, Brazil, Colombia, Chile, all these countries, right, Latin America countries, right, they already cut their central bank rate quite a while back already. Like I think as early as January, they start to cut already. So it is not to say that nobody is cutting, but actually quite a lot of countries start to cut already. I believe US is the only one that is lagging right now lah, considering that ECB also cut already. Okay, so in fact, for the Federal Reserve, right, they are the first to raise the rate, and it seems like now they are the last one that is going to cut lah. So I'm not sure if Bank of England is going to cut anytime soon. Also, I'm not really sure how the Singapore Central Bank is doing. I'm not sure how are the SORA rates right now. Also, I think they are still quite high lah, if I'm if I'm not wrong. But anyway, right, it's quite messy lah. Quite messy in the sense that there are enough justification for rate cut, and there's also enough justification for not cutting any rates at all. So we really have to see how it goes lah. Okay. So if you are gonna ask me very shortcut question like is all later market how go up or go down, I cannot answer you. I can't answer you. And in fact, I don't even care. I mean, I don't even care market go up or go down, because regardless of whatever happen, right, we are going to make money nonetheless. We are still going to make money nonetheless because we have a long short portfolio. Okay. So now, because the stock actually went up quite high, I mean, the stock market actually went up quite high, right? It is a little bit hard to play YOLO on stock, okay? Because I don't really want to short. It's definitely very bullish. I don't really want to short, but at the same time, it's also not wise to chase. So, in terms of YOLO, right, I'm actually thinking of going with forex pair lah, okay? So whoa, like a bit out of the norm, but I do believe in terms of forex pair, or rather the USD in general lah, okay? I think it still have a lot more downside to go. So I'm actually looking at UJ lah, okay? So when just now the CPI data came out, right, I actually played UJ. I got about $1,300 profit, but I decided to TP first, cash out first, okay, and then later FOMC, I may consider re-entering again. So if you look at UJ, right, it's actually have quite a bit of downside to go. So now, for those who are forex trader or what, right, the way I handle forex is very, very different now, okay? I don't care about support, resistance, I don't care about trend, I don't care about whatever the commercial, non-commercial, whatever the I don't know what those, the volume profile. I don't care whatever all the volume profile also lah. Okay, all those stuff I don't care. But what I'm looking at is looking at it from a more of a macro perspective lah. Okay, so now Bank of Japan recently raised the rate. They have gotten out of negative interest rate, and at the same time the US FOMC, right, they are also looking to cut rates now. Okay, I do believe they are looking to cut rate. I mean, they are no longer gonna hike already, so the next thing they can do is either hold the rate or cut the rate, meaning to say we have the what I will call the most disparity lah. Okay, disparity in the sense that BOJ is looking to raise, but at the same time FOMC is looking to cut, compared to, let's say, euro US dollar, where the European Bank is cutting, then FOMC also cut, Federal Reserve also cutting, so both are actually in the same direction. But for UJ, right, it's actually in the opposite direction now. Okay, so I'm actually looking at UJ, so we shall see how lah. Okay, we shall see how things go. But if you are looking to YOLO, most likely get your CFD account ready lah, okay, so that you can sort of join if we happen to have a trade lah. I'm not really sure we will have a trade or not. It's a little bit tricky lah, okay. Of course, due to the CPI, right, you can also see UJ actually drop quite significantly during the CPI. Now everybody is just waiting for the Federal Reserve announcement now. Okay, so I'm not sure if we're gonna spike up to do some funny move. Likewise, even for forex, right, I don't believe in nonsensical stuff like stop hunt lah, all this. I don't believe in those. It is just the volatility of the movement. Nobody is trying to stop hunt anyone lah. Okay, so I mean, that's basically my view based on what I've learned. So we shall see how. Okay, so now another thing to take note about this FOMC meeting is it is the June meeting. Okay, it's the June meeting, meaning to say we are going to have the projection material, which is very, very important. Projection materials are very important, because if you look at the previous projection material, which was in March 20th, okay, if you look at this, right, you can actually see there is no changes in terms of their federal fund rate projection. Okay, their federal fund rate projection is still 4.6. Last year, December, they say 4.6. This year, they also, during March, right, they also maintain it at 4.6, meaning to say we are still going to get a 1% rate cut, because currently the federal fund rate is now at 5.5. So in order for 5.5 to go down to 4.6, right, there's a 1% cut, okay? So they did not change this number in March. So now later when the statement come out, right, or when the projection material come out, we have to see if they change this number or not. If they still maintain, right, then most likely they probably have to start cutting soon already. Okay, meaning to say July they have to cut 25, 25, 25, 25, then you have 1% cut. Or they may end up, if let's say they don't cut in July, right, most likely they will cut 25, 25, 50 or something like that. Okay, so I do believe that June no cut, but July maybe they will start cutting 25. I also don't think they will straight away cut 50 lah. Okay, other central bank cut 25 basis point. European Central Bank cut 25 basis point. Bank of Canada also cut 25 basis point. So I don't think if Federal Reserve were to cut, right, they are going to do like a very big 50 basis point cut, okay? Which means to say that I highly anticipate July will be the first cut, 25, 25, 25, 25. Okay, so now the issue with rate cut is that everybody thinks rate cut mean market rally. It can be the other way also, where rate cut actually can mean market going down, because for Federal Reserve to cut rate, right, it means that the economy is doing quite bad, okay? But it is also mainly because right now, just nice that for today, the CPI data came out before the FOMC. So because of that, right, the market probably price in possible rate cut decision for FOMC already. Okay, that's why it went up so high. If you look at NASDAQ, right, it actually went up quite a bit. Okay, so perhaps even with rate cut news coming out, right, market may actually go down, because I mean it may already be priced in. So don't be too simple-minded, okay? Trading is never simple. If anybody tell you trading is simple, that person have no idea what trading is, okay? So sometimes you need to consider where the market is. If the market is already running out, right, then highly likely that perhaps the rate cut is already priced in. The news about an incoming rate cut is probably priced in. And of course, if let's say they change this number, they change the projection number, so maybe 4.6, then after that they raise it to 5.0, meaning to say instead of a 1% cut, they are only doing a 0.5% cut, then maybe that might cause the market to go down, because the market is kind of like pricing in a full 1% cut, okay? So that kind of thing can happen. So you really need to sort of understand what are the kind of stuff that is moving the market, okay? So now we are just going we have about 15 minutes left. Go and grab a cup of coffee. Go and put up your CFD platform. Go and put your UJ chart there, so that later if enter can enter, okay? So get all your stuff ready while we are waiting for the news to come in. So today the inflation number consensus is 3.5 for the core inflation, came out to be 3.4, so it's below consensus. And same thing for the headline inflation. The headline inflation is 3.4 and the actual number is 3.3. So that's definitely a very big win for the inflation coming down. Okay, but of course we have been stuck here for quite some time already. We have been like 3.2, 3.1, 3.4, 3.1, 3.2, 3.5, 3.3. So we have not gone below 3.0 yet. We are still stuck at that 3.1 to 3.5 like that. Okay, I do believe the moment we go below 3.0 to somewhere around 2.9 like that, right, then maybe perhaps we have really achieved soft landing. Inflation came down, the economy is still strong, because the service sector is still very strong. So maybe we may have really achieved a soft landing now. Okay, so looking at the market, you can see things kind of like U-turn back. Palantir initially was green, then now became red already. I don't know what's this one. Then Toll Brother actually gap up very high, but now coming down. So Toll Brother gapping up is actually a very good thing, because it is going to make our short leg. Okay, we got a lot of short leg in the loss, actually in a loss. So with Toll Brother going up, right, the short leg is now going to earn a lot of money. Okay, and because we already TP the long leg, right, we already capture the profit we got for the long leg, and now we are going to get the money from the short leg also. So we are going to profit both ways. So you'll probably see your overall Toll Brother profit is actually going up, even though Toll Brother actually rally. Same thing for Adobe also. Adobe, because our short leg strike price is 460, right? Adobe going up will probably mean we are going to get money from the short leg also, okay? So this is good news. And okay, Hershey is the tricky one, okay? Hershey is the tricky one because it fell too fast. It fell too fast. Our short leg is at 190 and now it's below 190 already. But not to worry, maybe it can rebound back. Okay, I don't know also. I don't know also because if you look at Adobe, right, it fell all the way to 440 before rebounding back to 460. Okay, so I do believe that it can rebound back up. So all these strike price for the short leg, right? It's not suka choose one, okay? We got a proper process for choosing where the strike price for all the long leg and the short leg based on probability. For example, let me just show you, okay? Let me just show you this. This is what we call a distribution of return. This is what we call volatility analysis. A lot of traders like to use the word volatility. A lot of all these gurus, suka. Oh, trader love volatility. Volatility is the lifeblood of trader, but actually they have no idea what they are talking about. But when we actually calculate, want to do a full analysis on what volatility is, right? We actually do this spreadsheet, and we are actually looking at standard deviation, median, mean, annualized volatility, all this kind of stuff. Okay. So now, if we are looking at Hershey, right? Hershey actually have about 10% chance to fall by 7.94% within a month. Okay, within a month, within a month. So if I'm looking at Hershey, if I'm going to a monthly candle, if I go all the way to 190, right? 190 is actually 3.78% down only. Okay, 3.8% down only. So now what is the percentage of Hershey going down 3.78%? You don't know, right? Of course don't know, because you need to have your distribution of return curve. So 3.78% is somewhere around here, meaning to say Hershey have probably 70% chance of staying above 190, 70% chance of not going down more than 3.97%. Okay, meaning to say there's a 70% chance within this month that Hershey can remain above 190. So now 70% chance is quite good enough. And of course, we also need to consider things like the premium on the strike price, because yes, we can go lower, but if we go lower, right, then the premium not good already, then you don't even want to short already. So we need to find a nice balance, okay? And then we figure that 190 is actually a nice balance. So who is to say maybe next week or even after FOMC, this whole thing may rebound back, okay? So these are the kind of what I will call the volatility analysis that we actually go through. In fact, it's quite a thorough process, I will say. So there's a lot of back-end work that you guys probably are not aware of, but most of the time, right, if things happen in a certain way, yeah, I mean, we purposely design the trade structure or the strike price to be that way lah. And that's why you are also seeing for Toll Brother, right? The stock is actually going ding-donging around like 115 like that, like touch the 11, almost touch 115 and then rebound back up. And that is because we purposely choose 115 for a reason. So these are the things that you have to be aware of lah. Okay, what's the time now? 153, just a bit more. Let's take a look at the market. Palantir is red, Adobe green, LOG. Oh, for those who don't have LOG, right, I think this is a very nice level to get in. Actually, if you look at my CFD, right, I actually bought this today lah, okay, today 1,000 share at 2.64. And on my interactive broker also, I got trades. Oh, it's already the next day, but you can see here I got 4,000 share at 2.63, which I got today also. So quite a substantial amount lah. McDonald is green, which is good. Hershey is going down. So now this is the kind of movement that we want. Okay, McDonald going up, Hershey going down. So these two are actually what I will call in the same sector lah, and it is what we will call a same sector pair. Same sector pair. Okay, one long, one short, and they are in the same sector. So why do we call it? Why do we say they are in the same sector? Because they are actually defensive consumer staples stocks lah. Okay, because regardless of recession or whatever stuff, right? People are still gonna buy chocolate. People are still gonna eat McDonald's lah. Okay, I mean McDonald's, how expensive could it get? They're actually doing a lot. Recently, you see a lot of value meal, right? Those $5.65, don't know what. I mean, this it's a staple stock lah. In fact, if you look at other staple stock also, you can actually see McDonald's is doing quite okay compared to the rest. Cow up about 0.98, General Mills down, Kroger down, Hershey down, Walmart down. So the fact that our long is up and our short is down is actually a good thing. A lot of stock actually U-turn already. Victoria's Secret initially was up like 5% and then after that came down. But I think Victoria's Secret no chance really lah. Most likely going to have to cut. Okay, at 155 already. Let me open up Bloomberg. Okay, so later what we are going to do is we will read the statement and then we will see the projection material. And then we will listen to whatever Bloomberg have to say lah. I do think Bloomberg provide very, very good opinions and very good analysis. Vita Coco is one of the company that we analyzed quite a long time back around here, somewhere around here. We are actually re-looking at this now lah. Okay, so back then when we were analyzing Vita Coco, right, we were also analyzing Celsius Holding. Back then Celsius Holding was around here. So you can actually see we got quite a lot of Celsius Holding both for long position. And it did very, very well. Okay, this is because of the stock split lah, okay? Because of stock split, that's why it went down. So in fact, around March 2023, which is somewhere around here, March 2023, we actually got in and got a very big run. So Celsius Holding and Vita Coco, they are also similar sector. Both are drinks company lah, okay? One is sports drink, the other one is also considered sports drink lah. So they are in the similar sector and they are growth company lah. So but recently Vita Coco kind of outperforming Celsius Holding for whatever reason. So we are trying to look back again at Vita Coco to see what's going on. So when we look for stocks, right, we look for this kind of stuff lah, okay? Whenever people talk about drink, what do most trader buy? Coca-Cola. So boring. Let's see what's the time already. 57. Okay, let's take a look at UJ 5-minute. This one, let's look at S&P. Okay, let's see, 2 more minutes. Okay, very simple. I believe they are going to maintain at 5.5 lah. Okay, I don't think they will do a surprise cut. They will maintain at 5.5, but after that, most likely they will say July will cut lah. That's my prediction. Okay, that's my prediction. Like whenever FOMC, a lot of people like to do funny prediction, but I mean you predict for what? You predict rate, like if you are not trading, you just anyhow predicting, then like you correct or not correct, it doesn't matter also. Like a lot of trader like put in their entire ego into making FOMC prediction, which I find it very, very lame. Okay, so you can also see here the rate projection, right? You can see the current projection rate is 4.6, which is referring to the 4.6 that I showed you just now, okay? So let's see if those numbers change or not. Wow. I started this account during the month of May with 100,000. Now it's almost 110. I'm up about, going to up about 10K, 10% already. And you can see all the trades that I'm taking is the trades that I'm sharing with you. And it's not to say everything win also. I actually have quite a few red one. But I mean, it's a long short portfolio. So those red, I don't really care. Okay. Let's see. 59. Count down. A few more seconds. We don't need to chase, we don't need to chase, okay? If it move, let it move. Okay. It's recovering, dollar recovering. Yeah, 5.5 lah, okay? Okay, so it's 5.5. Okay, let's take a look at the statement, statement important. Okay, so let's read this. Okay, now reading the statement is very important. We will read the statement and we will actually record a few things, okay? So now for FOMC statement, right? It is not just read, and then you suka, you know, the way they phrase the sentence are very, very important. Not only you need to read what is there, right? You also need to be careful of what is missing. Sometimes they will take out certain sentences that are present in the previous statement and they will take it out. And when they take it out, right, it is for a good reason. So not only you need to see what they are writing, you also need to see what they have left out. And that is where a lot of other gurus, they fail to see. They just read all this and then they just make a very surface level indication, like a surface level analysis, but they don't really understand what's going on also. So this is my macro dashboard. Okay, very long time never share my macro dashboard, but I am sort of diligently updating my dashboard. So what I want to sort of highlight is that we actually will take note of the FOMC statement and whatever that they are trying to change. Okay, so whenever there's a highlighted stuff, right, highlighted row, it means something changed. Okay, for example, here they increase the rate for the first time. Here they decrease the QE for the first time, and here they decrease the QT for the first time. And then from maintain, they start to use the word assess. Okay, all these things are very, very important. Okay, so recent indicators suggest that economic activity has continued to expand at a solid pace. Job gain has remained strong and the unemployment rate has remained low. Inflation has eased over the past year but remained elevated, okay? So they still think it's elevated. So for the past few statements, they always say this, okay? But there will be a time where they will no longer use the word remain elevated, and that is something that you need to watch out for. In recent months, there has been modest further progress towards the committee 2% inflation. Okay, so this is actually new. Okay. This is actually new. Let me check. Let me check previously have or not. This sentence is actually new. So sometimes if you are not aware of what the previous statement is, right, you won't know what are the new one, what are the not new one. You see here, in recent months, there has been a lack of further progress towards committee 2%, but now they are saying there has been a modest further progress. So one is lack, one is modest. So that will actually mean now Federal Reserve maybe is now more keen towards cutting rate. The committee seek to achieve maximum employment. So if you are like just read suka, just want to share the screenshot or what, right? All these things you won't notice one. You definitely won't notice one. You'll just read this at a surface level. But if you read it and pay attention, right, you will definitely notice this kind of language change, which is very important. Committee seek to achieve maximum employment and inflation at rate of 2% over the long run. Okay, this one we know. Okay. Committee judges the risk of achieving its employment and inflation goal have moved towards better balance over the past year. So this is actually a new phrase also, a new statement also. Oh, okay, they put it here also. Economic outlook is uncertain, but committee remain highly attentive to inflation risk. In support of its goal, committee decide to maintain. Okay, so they decide to maintain now. In consideration, any adjustment to the target range for the federal fund rate, the committee will carefully assess incoming data, the evolving outlook and balance of risk. Committee does not expect it will appropriate to reduce target range until, okay, so they are not going to read. So, okay, so now this statement is very important, okay? The reason why this statement is very important is because they are upfront telling you July no cut. They are upfront telling you July no cut. So that is where I will like, today is what? Today is 13 June 24, 5.5. 0 and maintain. Meaning they are not going to cut, okay? Meaning July no cut. So I will like make a comment here. July no cut. And that's probably why you see the US dollar going back up. Okay, that's probably why US dollar going back up. And stock market probably start to go down already. Stock market, yeah, stock market go down a bit. But our stocks are okay. Our stocks are okay. Oh, 10K 了，10K 了 ，screenshot time 10K 了，10K 了 ，I'm so happy 喂啊 ，OK， sorry OK， the committee will continue reducing its treasury security and agency debt, blah blah blah. Yeah, so they will continue to reduce by this amount. Okay, so it's still they did not change. Minus 2.5, minus 35. So how do I know it's minus 2.5, minus 35? They actually stay in their previous statement. Here. They reducing the monthly cap of treasury security from 60 billion to 25 billion. That's why initially 60 become 25, but the mortgage based security is still 35 billion if I'm not wrong. Yeah, still 35 billion if I'm not wrong. Okay. Let's continue. Committee is strongly committed to returning inflation to 2%. In assessing appropriate stance in monetary policy, committee will continue to monitor implication of blah blah blah, adjust blah 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 blah. Okay, okay. So now, this statement, right? There's only two important information. Number one, committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence. So whenever you see this kind of statement, right, it's telling you what they will do in the upcoming month. Because if they are going to reduce, right, they will tell you here that they will be reducing it next month. So they will tell you one. So if they write this sentence, right, it means that they are not reducing next month. So we already know the next July FOMC, they are not going to reduce, okay? So it's a known information already. And sometimes I find it really funny when all these gurus start to share their analysis, like, oh, July will reduce, not but actually, like, it's upfront. We already know the information here. Then the other one is this one, okay? So inflation have no, where is that? This one. In recent months, there has been a modest progress. So the modest, okay, modest, but it's still not good enough. It's still not good enough. Okay, so we are done with the statement. Now projection material is very important. Let's look at the projection materials. Important. Oh, I see some number change. 5.1. You see why USD why suddenly like the the yields are like recovering. You can see the yields kind of like shoot back up. It's because they raised lah, okay? They raised the outlook. They raised the outlook here, 5.1. Okay. So most likely I will expect I will probably expect stock market to retrace. I will think stock market will retrace. So maybe we can play stock market. We don't need to play UJ. With this new information, we can probably play the stock market. Yeah, we will try to go for S&P put option or something lah, okay? Yeah, so this is very important. And GDP is still 2.0, 2.1, 2.0. Maybe we can long UJ. If like that, we can probably long UJ. Yeah, you see, it's going back up. Okay. I'm gonna long UJ. I'm gonna long UJ. Where here. Stop loss 155.5. 155.5. Okay, this is in yen, okay? This is in yen, not SGD, but this is somewhere around 1000 SGD lah, okay? But I'm not gonna risk 1000 SGD on this. No. This is about $600-700. $600-700. 688 $688. Okay. Let's go. Okay. Okay, I'm done with that. So later we can play S&P or something lah, okay? Play S&P or Nasdaq or something. But a lot of Steel Dynamic is red. Hershey is red, which is why I'm getting a lot of profit from Hershey and Steel Dynamic. I mean, Palantir going down already. But you see how the effect of the long shot. Yes, Palantir go down, but I don't care. Because Hershey and Steel Dynamic is doing very well. Then McDonald. What's my McDonald? McDonald is recovering. Which is good. AMI is down. Allogene is a YOLO stock lah, okay? Just holding down 5%. Okay, so now we wait for the what do you call that? The conference lah. Should I TP? Should I TP something? Warning, you have too many trades open. Oh no. I got too many trades open. Commission $95, yeah. You see my win rate only 57%, but I'm actually up about 10% already. So win rate doesn't matter. HPE is my biggest loss. And this is the main disadvantage of CFD lah, okay? Because CFD, when earning comes, right, the earning gap, there's no way for you to avoid it. So actually my HPE, right, my stop loss, right, my stop loss, I only intended 1,005 stop loss, but the HPE gap up like 20%, yeah, then it become like $3,500 loss. So I actually lost more than what I intended because there's no way to prevent that gap up. Option, you can limit your loss because the most you can lose is your option premium, but for CFD or stock position is a little bit different. So I'm pretty disciplined. It's just this one, the HPE. So I have realized profit. My realized profit is about 5,006. My unrealized is about 4,007. So I'm like 110K already. Trade journal. Risk reward 1? No, no, no. Bluff who sia? Those that I lose like 1,000 only. Yeah, see those that I lost like $800, $800. But those that I win is like 1,000, 1,008, 1,004, 4,000, 1,003. Only the HPE I lost 3,005 because of the gap. Is something I cannot avoid. Holy crap, my UJ doing quite well. Should I add more or not? Should I add more or not? I think I can add more leh. I think I can add more, yeah. It's only $600 risk. Yeah, add more lah, add more. Wait. Okay, maybe what? Wait if that's the case, might as well, I think play Euro USD better. Play Euro USD better. Because Euro cut already, but USD they are not gonna cut so much. So maybe there might be bigger movement. What are my FX? So it should start coming down already. It should start, yeah, it start coming down already. Don't know late. I don't know how to manage late. Never mind. Let me ship. Got music or not? Okay, there's music here. Okay, good. At least we know lah. At least we know if Jerome Powell come and speak. Okay, never mind. Let's this one we just leave it be lah. Okay, we just leave it be. Let's go and plan our option a bit. Okay, okay, should we play SMP? Should we play SMP? Or should we play triple Q? Or Russell 2000? What? I don't know, man. I don't know what is this. Okay, July 21st, which is like just a few days away. 542, 540, 540. 540 is here. Put option. $2.70. Okay, $2.70. $2.70. And then close the gap. We can play until close the gap. That's only 1%. 1% not a lot. Maybe until 530. 530. 2.22%. Okay, 530. 530 sounds reasonable. Sounds reasonable. 530. 530 only 64 cents. Profile. Hey, not bad not bad 369% risk reward ratio. Not bad how about 5 unit? 5 unit. 399. If I buy 5 contract, it's 399. But I'm risking like $1,500. I'm risking about $1,500. No, $1,000 only. I risk $1,000, I can get 3,000. But I mean, you have to go to 530 lah. Okay, it has to go to 530. It's to go to 530. Possible or not? Possible lah, huh? I think can enter now, leh. I think can enter now. I'll enter now. I'll probably enter now. What's my beta? Where's my beta? Beta 3.5. Okay. I think I'll enter now. Okay, Okay. 来。SPY long put 21 June 24 strike 540, right? 540, right? Yeah, 540. Then short put 21 June 24 strike 530. Okay. You go and enter. Wait, let me enter first. What? How much is it? 1,000. Okay, 1,000. Okay, go.
Order filled.
Okay, order filled. Okay, my order filled already. Okay, your own self. Okay, I go and update on Discord. This is YOLO. You all lose money. Don't like. I always lose one. Don't do that kind of stuff. If you are not doing long shot, I don't know lah. Okay, so you can see just now I risk only $1,000. My normal risk is like 5,000 one. So this one I only risk $1,000. Own self take care. This is what is this? This is trade setup. Trade setup what already? Trade setup 46 already, yeah. SPY, FOMC YOLO, option only. Okay. Okay, my SPY is here. Okay, my SPY is here. You see my Applovin 不带不起，一进去就输1000块啊。All this. Large price change. Total have, oh, okay. Okay. Earning notification. Oh yeah, the what do you call that? Adobe earnings, Adobe earning coming out. Hey, why lose money already? Oh, oh, okay. Okay, I already put on Discord. Okay, you all go and look at Discord. I will start looking other stocks. Yeah. Um. So sad. Allogene went down. Oh, Palantir is green. Palantir is green. Good job. Good job. Hershey is still down. Still Dynamics still down. McDonald's still stuck there. Actually, like not much movement, leh. There's not a lot of movement. It's not a lot of movement. We got, hey shit, the option expiring next week. Like the option is expiring next week, 21st. Oh my god, we got only like 6 days. We got only like 6 days. Oh no. Oh no. Oh, this is QQQ. Wait, this is QQQ. SPY is here. Shit. 2.22%. 2.35. Okay, okay. There's sufficient volatility. There's sufficient volatility. 1 week SPY can go down about 2.4, 2.35% like that. But it have to start going down now, okay? So hopefully the moment Jerome Powell speak, it start to like zoom down. Is he coming out? Not yet. Okay, yeah, I think I don't know, I think I should TP something like. My this account started with 220,000 USD. Now I'm up about 12k USD for the month of May lah. For the month of May. So this 12k USD plus 10k SGD, this SGD, 10k SGD here. I'm actually up about close to 25,000 in a month. About 25,000 in a month. Hopefully by end of the year I can make like 200k, 300k on the trading account. Oh no, it's coming down. Need to wait for Jerome Powell to speak. Ablovin also going up, recovering a bit. This one like Sui Xia enter already, then all the way go down. Like I enter it like at the top there. When I enter, it was like at the top there. But you can actually see it doesn't affect my portfolio much. My portfolio is still up 2.5k for the day. Okay, the beta went down already. The beta went down already because of the SPY put. Just now my beta was like 0.55 like that. It was quite bullish. So I need to bring it down. Applovin down about $900, $986. The moment I entered, it dropped already. You can see my unrealized is actually quite big, and this is actually big because of the Toll Brother lah. Okay, because Toll Brother we TP the long leg, but the short leg is still losing a lot of money, and then we left the short leg there lah, which is why there's quite a big unrealized profit. But actually, the realized is very big. My realized profit on Toll Brother long side was like 13K like that. But now, hopefully, due to this rally, right, due to the Toll Brother rally, the short leg is now going to profit also. So we get profit on both sides, which is a good thing. Okay. 来了。Oh no, it's recovering.
Good afternoon.
Wait.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets.
Market data connection lost.
The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
Lost.
In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamarosa of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible, but I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as, building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that so that what's in the SEP actually does reflect the data that we got today to the extent you can, reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
Janelle.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina. Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer-run, slow-moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate. And we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. Look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. So that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that, but. And of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably down 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. we're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction, but one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene. Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people who are at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, and particularly the second half of last year, and we continue to see still strong growth, or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is, anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about, your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take, several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute rental value to owned homes, and that's, many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as they're spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria.
Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken? When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move to weaken quickly.
So waiting for that to happen is not what we're doing. You know, we're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So, and also the fact that we look at all of the whole situation. So, you know, a decision to begin to, loosen policy could have several reasons associated with it at a given time. But I would just, we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I mean, I can think of things that many things would make it on that list, but I don't think I'll butter them here.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that, it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's going to be the totality of the data. The labor market data, the growth data, in terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Kosuke.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't, actually it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once, you're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation?
So we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth all forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't, there isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or, alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So.
But if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter, any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
Okay, guys, so FOMC is done. So there's not a lot being spoken here, not really a lot of new information, but basically they are still not confident yet, okay? They are still not confident of the inflation. So of course the major thing is this one. Federal fund rate projection is now 5.1. So I'm guessing there will be 2 cuts, okay? I mean, if this were to remain, I'm guessing there will be 2 cuts, 25 basis point, 25 basis point, okay? But nonetheless, you can see the market kind of like rallying a bit, but now it's kind of going back down again. So I do think S&P will go down further, okay, will go down further, but it's just depending on when, so maybe the market will sort of digest a bit, marinate the information a bit, then maybe next week it will go down. So you can see how things are playing out, like super tyco, right? Super tyco, like before touch then go down already. So you can see how suddenly my profits start to jump, okay? So you can see my UJ trade currently now at 52,000 yen, which equates to about Sing dollar 447 lah. Okay, then at the same time, my USD is my S&P 500 now is like the loss is narrowing lah. Okay, hopefully it goes into profit. Then I mean it will be all good really lah. Okay, so these are some of the live trades that I'm taking. So I mean it's live trade lah. Okay, as you can see how I take my trade, very simple, naked chart. No volume profile, nothing, no MACD, no RSI, nothing lah. Okay, literally nothing. Is naked. It's like as naked as it can be lah. Okay, and I'm almost up about 600 SGD now already. Of course, that's on top of whatever my other stock position are running lah. Okay, you can see Hershey is running, Steel Dynamic is running. The other stuff I don't know lah. Okay, so this is basically a long short portfolio also. There are a lot of long, but actually you can see those that are being profitable, right? It's actually quite equal. Palantir profitable, one long sets profitable, the rest I don't know lah. Okay, hopefully S&P will become profitable soon also. You can see now it's coming down already. Okay, so there's really no secret, nothing much to it. You have seen me, you just saw me execute the trade live. There's no secret on where the stop loss, where like don't keep looking for shortcut numbers. It doesn't exist. If you once you pay attention to the overall picture, once your account is big, once you are sort of comfortable with the lot sizing, once you have that mindset of not wanting to get rich very fast, like those with 5K account want to become 10K account within like 2-3 months, not possible. Okay, I can get 10K profit because my account is 100K inside, so it's simple. So you can see everything is now working out already. And the reason why I took this trade is very simple. It's so simple. It's based on just one single data alone, and that is I saw the federal fund rate projection being revised up to 5.1, and then based on that, everything else is risk management. Everything else is just common sense lah. Okay, there's nothing else involved. So stop looking for all sorts of funny holy grail strategy lah. Okay, yeah, I mean now things are going in my direction really lah. So all the best guys, all the best. 111 ready. 11. I think today I got about easily 2K on CFD alone. I think I got quite a substantial amount on my IBKR also lah. Okay guys, so that's how you do trading. The chart is as naked as it can get lah. Okay guys, so all the best to you all next week. I mean this coming week lah. Okay, and don't forget Adobe earnings is coming out soon, tomorrow after market. So if you want to run, you can run tomorrow market hour lah. Okay, but those who are not in position, right, I don't recommend you to go and take a YOLO position on Adobe lah. Okay, because Adobe is quite expensive. And the risk is a little bit hard to manage lah. Okay, so I'll just keep to whatever position that I have. I'm not taking additional position until the Adobe earning is out. But aside from that, right, all the events, all the data for June is out already. So I think we somewhat have a good direction. Maybe we want to trim some long position already, and maybe focus a bit on a short position. So meaning to say the Aplovin trade that we took this like just now, maybe I will cut tomorrow already lah. Okay, I'll cut that trade tomorrow already, and then maybe I'll start looking a bit more for short position lah. Okay, Pfizer maybe, I don't know lah, Pfizer like quite jialat already. Then I will start looking on more for the short leg really lah. Okay, so for example I got UNCUT that I wanted to short. So now I think it is quite a good candle coming into short already. So all these things are playing out already lah. Okay, so you can see all my decisions are basically based on macroeconomic data and mainly earnings and all this kind of stuff lah. You will hardly see any kind of technical analysis from me, almost none at this point already lah. Okay guys, so once again, all the best for this week. I'll be here. I'll be here for the entire week lah. Okay, so any trade that goes up, of course you will know lah. Okay guys, have a good night and see you guys on Friday. Bye bye. How you determine TP for forex pair? No TP, no TP, no TP. I don't know. Once I'm happy, I'll TP lah. Okay. Once I'm happy, I'll TP. But there's a guideline that I follow lah. But that guideline is more of volatility analysis. So you have to understand what is the volatility of the pairs that you are trading. For example, if I'm trading UJ, you have to sort of know how much can UJ move within a day? How long are you intending to hold UJ? If the UJ can move 2% in a day and my holding time frame is only 1 day, then I will TP after it moves 2%. Okay. So how do you know how much will UJ move in 1 day or 1 month or 1 week based on whatever time frame that you are trading? You have to do your distribution of return, your DOR, your something like this. You have to do something. You have to do this whole thing lah. The one that I showed just now. Okay, so instead of using the stocks data, you will have to use the UJ data, and of course, this is not an easy thing to do also lah. So no volume profile, no support, no resistance. I don't care about those. I TP when I feel that okay, I think I earn enough, or I have a rough guideline based on the volatility lah. Okay, in this case, I somewhat know what's UJ volatility is like. It's about 1.5% per day. Of course, it's not going to move exactly 1.5, but when it get close to that movement, right, I probably know, okay, UJ most likely done for the day already lah. And then of course you have to factor in other things also, like are there any economic data coming out, not only on USD but also on Japan. Japan tend to do a lot of surprise movement, so you have to be careful. And then you also need to take note of things like the trading hours, because UJ will move during the US hour where the dollar is moving, but also early in the morning when the yen the Japan market open. All this kind of stuff you have to know lah. Okay, so you don't sit around during the European hour or during Singapore hour and then you're wondering how come this pair is not moving, because Tokyo market closed already, US market haven't opened. Of course UJ is not going to move lah. So there are a lot of things. So you really have to be well-rounded in whatever stuff that you are doing. And you can even see for my stock position or on my CFD platform, right? You can see they are equally making a lot of profit. And I have no secret. I literally have no secret. I just entered based on whatever that I my fundamental, my volatility analysis. So yeah. So once you got it right, once you catch it really, you can earn money on CFD option, whatever lah. Okay, whatever that you don't need to scout for things like what's the best platform, trade option, trade stock, trade CFD, all these you don't really need to care one. It's actually everything is quite straightforward lah. Okay, so let's talk again on Friday. If you have question to ask, if you want to chit chat, do come on Friday. That's where I'm free to talk lah. Okay, most of the other days I'm kind of like just I talk, you listen kind of. Okay, goodbye, good night.